Welcome to the Trading Desk, where money talks and conventional wisdom walks. I'm Dave Floyd with Aspen Trading Group, and joining me here is Matt Davio with Red Rock Partners and Jesse Felder of Felder & Co. Before we get into today's show, let's review what happened in the markets last month.
Last month, we had a big reversal in the markets where the prices went down. The S&P, as you can see on this chart, came down July and August. Prior to the Fed meeting here in mid-September, they rallied all the way back almost to the old highs. Can the rally stay? We'll have to wait and see. The next chart I want to show and talk about is the 10-year note, which is interest rates. This is what your most common mortgages are based upon, both the 10-year and the 30-year rates. Prior to, again, the Fed meeting, the rates have gone back up approximately 10%. So this is not really a good thing for homeowners as interest rates have actually risen into this Fed cut, and we'll again see if this stays. The next two charts are side by side. What you have is the dollar index chart on the left and the commodities index chart on the right. What's interesting about these two is that they're diverging. Your dollar is actually worth less, means it takes more dollars to buy goods, and the right side makes this a double whammy in that commodities, all the things that you buy to produce and use in your daily lives, are shooting through the moon. They've actually gone up about 12% in the same time period. So we've got a stagflationary environment where you've got wages and the dollar worth more, and it's taking more of them to buy goods and services. So this is not a good thing for the economy in the long run, and potentially should lead to, in our opinion, possibly some higher interest rates in the long term, which is counterintuitive to what just happened and what the Fed did. The final chart we want to show tonight is the market volatility index. This is going back 7 years. You'll see on the left side, going back to the year 2000, the market bubble years in the NASDAQ. What you saw really from 2000 to 2003 was high volatile days in the stock markets. We then proceeded from 2003, when shock and awe began, all the way through early 2007 to have fairly low, if not any, volatility in the markets, which led to a rise in price. Since then, we have the last 6 months, we've seen a greater increase in volatility, which should remain. You can see this chart looks to be moving to the upside, which would mean more volatile days for the markets ahead.
As you can see from the slides, we've had a very steep drop in September in the markets, but we've largely recovered all of those, and we're within striking distance of Dow 14,000 again. Most of this is largely due to the half-point interest rate cut by the Fed last week, and I think all of us here would agree that that is probably the main catalyst. What are your thoughts on that, Jesse?
Well, I agree. I think there's a lot of talk on Wall Street. First of all, the market had rallied a bunch off of the lows before we got the Fed rate cut, but last week into the rate cut,
crazy.
And afterwards, we went up 300 points in a day. I think, Matt, we were up 2.5%.
Yeah, we were up 2.5% for the week, but I think a lot of the move happened prior to the Fed making the announcement.
Right. Well, it was a surprise, though. I mean, most of the
it was a surprise. The 50 basis points, most people were predicting 25. So there was a lot of excitement and a lot of aura around the market going up. But the big thing I noticed was volume was quite lower than it was, say, 2 weeks ago before the Fed surprise announcement. So you got to key in a little bit. Again, even if you're not a trader out there, you've got to look at the volume, and that really tells you a lot on how the institutions are behaving. And I didn't see a lot of follow-through, at least before our taping today, with the institutional side coming into the market.
You know what's really interesting is that stocks have made a moonshot on that half-point rate cut. Bonds, ironically enough, have been sold off really hard, almost as if they're anticipating that this move lower is going to be quite inflationary.
Yeah,
which is
the
what I
general
took away from
public,
it.
the general public, people I talk to say, wow, rates are lower. And you say, well, short term, the Fed funds rate that only banks have access to is lower, but your mortgage rates went up last week.
Yeah,
so
your long bond actually fell from 114 down to 110.
Down, rates went up.
So almost 3.5% on the long bond. The 10-year rate went up about 12% last week. So you had an actual increase in interest rates over the course of the week. And so if you go to get a new mortgage this week, you're going to pay more than you did the week before the Fed.
Bottom line is, last show we talked about increased volatility. We had this dramatic sell-off, and in the months since the last episode, we've had a huge ramp up, and we're right back. So it's still volatile, it's just volatile in another direction. So.
Right, exactly.
Okay. We need to take a break, but when we come back, we're going to continue to discuss this topic and, more importantly, how you can design your investment portfolio to accommodate this increasing market volatility.